On the 5th of June 1967, Israel launched airstrikes on Egypt and successfully expanded its territory by capturing the Gaza Strip, the Sinai Peninsula from Egypt, and the West Bank from Jordan. This is known as the Six-Day War, and it significantly altered the map of the Middle East, and this is marked as the event that set off a decade of destabilization in the region. From 1970 to 1980, oil prices suffered from terrible supply shocks, going from $3 a barrel in 1970 all the way to $40 by the end of the decade. As a result of various geopolitical conflicts in the region, these oil shocks were directly responsible for the three impressive waves of inflation that occurred during that period, where inflation in the United States eventually reached a staggering 15%, with 4 consecutive severe economic recessions during that period. This deadly combination of high inflation and high levels of unemployment became known as stagflation. And during this period of stagflation, the US stock market experienced multiple 30% plus drawdowns, including one devastating 50% drawdown in 1974 that wiped out more than a decade of price action on the S&P 500. Today, we've just seen something called the geopolitical risk index make the largest spike since February of 2022. This is the moment where Russian forces began their invasion of Ukraine. The geopolitical risk index is an indicator that basically measures news coverage of geopolitical tensions around the world. And when it spikes like it did in these instances, it means that geopolitical tensions are rising, which is exactly what happened just a week ago, along with a spectacular decline on the S&P 500 that witnessed a rapid 7% drop from its all-time high, a direct result of rising oil prices and rising interest rates. Many are concerned that this is just the first move down, as we experience another stagflationary 70s or another similar period to what we saw in 2022 following the invasion of Ukraine. So is that what's happening? Is that the environment that we're heading into? And that we should compare this move down that we're currently seeing on the S&P 500 to this one in January of 2022 that was just the beginning of the 2022 bear market? Well, firstly, when we look at the geopolitical risk index, we see that for now, this is just a temporary spike. So we're not seeing the same type of sustained geopolitical risk as we saw in 2022. The index today has already come down quite a bit since Israel's strike. When we take a look at what oil was doing in 2022 when Russia attacked Ukraine, we saw an extremely aggressive breakout above an important trend line, and oil prices over the months that followed stayed at very elevated levels. Higher oil prices means the cost of transportation goes up for most people, which is very likely to reduce their spending on other things. So higher oil prices were a direct cause for the economic weakness that we witnessed in 2022. Today, we've just seen oil reject off an important resistance line. If geopolitical tensions were actually escalating, we would have seen a proper breakout, not the rejection that we're seeing today. We actually currently have an active short trade on oil on the website, so this is a trend line that we're watching very carefully. It could still be that oil breaks out, in which case we'd expect the stock market to continue moving lower, but today we have to listen to what the chart is telling us, and it's not telling us that we're seeing a major oil shock like we did in March of 2022. Back then, we also saw the S&P 500 experience what's called a death cross shortly after the invasion of Ukraine. A death cross is when the shorter-term moving average is crossing down below the longer-term moving average, and that reflects a turn in the momentum of the price. You can see in the 2 years before that death cross, the momentum was strong and the stock market was rising. Following the death cross, momentum began to turn and the stock market dropped another 20%. Today, momentum is still very strong, not at all the same look to what we saw here in March of 2022. In fact, in January of 2022, we saw the stock market break down below a very important price channel, a price channel it had respected throughout 2021. And from the moment that it broke it, we saw the S&P 500 began to trend lower. Today, on this recent move down, we're not seeing a similar type of breakdown to what we saw in January of 2022. The S&P 500 has actually broken out of a key price channel and seems to just be retesting it for now. So far, we've gotten this correction spot on at Game Game of Trades, we laid out 3 short-term targets to our members for this correction, and all of them have been hit very rapidly. Now, at the end of last week, as the S&P 500 hit our final target, it also reached extremely oversold conditions. The most oversold they've been since October of 2023. This is a chart showing the percentage of stocks that are trending above their 50-day moving average. That may sound complicated, but it's basically just telling you what percentage of stocks within the S&P 500 are trending up. And so early this week, we only had 30% of stocks trending higher, so the vast majority of stocks within the S&P 500 were trading down. When that happens, it means there's some form of a widespread panic. When we look at the last 3 times, we've seen less than 30% of stocks moving higher. Each of these moments were pretty good opportunities to buy the stock market. When we go back to 2021, all of these moments were similar types of panics and happened to also be great opportunities to buy the stock market during a solid uptrend. Now, in 2022, all of these oversold readings weren't such great moments to buy the stock market as it continued to move lower and lower, but as we laid out, today looks different to what we saw in 2022. This could, however, be more similar to the 5th of June of 1967, which is this moment right here. This is the moment where Israel attacked Egypt and began a decade of geopolitical destabilization in the Middle East. But in the near term, the stock market dropped 6%, and once the concerns died down, the market bounced and moved up by 20% over the next 6 months. On Friday of last week, we began to add some trades to our active trades on the website as the S&P 500 began to get oversold. We're really starting by accumulating areas of the market that we think have the most potential imminent upside. If we begin to see signs that the market is indeed reversing, we may begin adding much more aggressively. We're closely watching the stock market at gameoftrades.net. We have a 7-day free trial, so make sure to take advantage of that